Mark, let's talk about the markets in 3 minutes. And because we've been talking about China there, let's continue on that theme. What's your overall takeaway from this suite of data we've had out of China? Some of it described as mixed, but maybe you think that underplays some of the strengths, and the policy response.
It is mixed, and the comparison period was just so weak that it was easy to have high numbers. But it's interesting, we're talking about a retail sales number missing because it only got 10% growth year on year. And obviously, that's a kind of growth level that nowhere in the Western world is matching. And I know it's against a weak period, but still, it's a reminder that, that the negativity around China needs to be calibrated correctly. China has disappointed expectations this year, but it's still an economy that's growing faster than most Western economies, almost all of them. And it's not like near depression, it's not near recession, it's just disappointing its own high expectations. Now, at what point does that become a positive market story? Well, something that I always used to repeat in the other way, so I've got to remind it here when I try to be positive on markets, is that Chinese markets are almost never an economic story. They're a liquidity story, they're a policy story. And I'm not yet seeing the policy move or liquidity move that's really changing the narrative for Greater China stocks just yet.
OK, and so hence we get that disconnect between the news we get and the way that stocks perform. Let me ask you about the post-Fed rally, the rally in everything, the Santa rally come early perhaps, or not even that early, the middle of December we are now, aren't we? You think then perhaps this has further to go, Mark, from the price action you're seeing? Does this last at least into the new year?
Absolutely. This was just a momentous shock. I was so bitter I missed the show yesterday because this was just a massive Fed. I mean, if you before the meeting, there were basically 4 options, and this was the one that to use my own word, was highly improbable. It was the idea that the Fed would promise cuts, not because they're worried about the economy, but because they're really investing deeply in the disinflation narrative. It's like a repeat of 2021. And what happened in 2021? Well, stocks went to the moon. So yes, we know this is a market that seems stretched on many technicals. It seems like it's already gone too far. Valuations are high. Sure, but we got that in 2021. That just makes there's a little bit of volatility. It means there'll be hiccups in the way when we get some data that don't go along to plans. But overall, this is going to keep going higher until the hard data forces either the Fed to realize, no, they're not going to be cutting rates, or to get more worried about growth. And for that amount of data, it's got to be the new year.
OK, and you are still expecting that to come, are you? That point where we get what a hard landing is. That's still your expectation, Mark?
I have to say, short term, I want to be in the no landing camp. But I do ultimately think that, yes, I do think that growth is slowing down, but it's not slowing down as quickly as expected. I thought the recession would start this month. Now, I know the data we've been getting, like retail sales, is for last month, so it's not yet the turning point. But there's no real sign of the market really collapsing just yet. So I think I was probably a couple of months early in that view, but I still think I am worried about the growth outlook. But the Fed has sent a message: ignore the data for the moment. Right now, you've got to trade a no landing scenario for at least the next few weeks.